Hey everybody, it's Justin from Number Crunch Nerds, and in this video we're going to be solving accounting problems using T accounts. Okay, here's a T account right here, and here is our accounting problem. It says, for the year 2022, Maxwell Company sold $150,000 of products to customers on account. They collected $83,000 of accounts previously outstanding and calculated an allowance for doubtful accounts of $3,500. The ending balance in the receivable account was $121,000. What was Maxwell's opening balance in the receivable on January 1st, 2022? Okay, so when you're given a problem about account balance questions, the first thing you should be thinking about is T accounts, right? T accounts is how you get organized, and that's always the first step. Any accounting problem, you got to get organized, because as soon as you look at this and you see all these numbers, you're like, oh, there's like so many different numbers here. What do I do with them? The first step, organize them, okay? So let's just start doing that. It said, we sold $150,000 of products to customers on account. What does it mean to sell on account? Well, it means to sell not for cash. It means they have you have an IOU from your customers. And in the accounting world, in accounting words, an IOU means what? It means accounts receivable. That's what an IOU from your customers is. It's an accounts receivable. So if I sold $150,000 on account, meaning on credit, not for cash, then what's going to happen to my accounts receivable? Well, it's going to go up, right? I mean, I sold $150,000 on account. So my accounts receivable has to go up by $150,000 because they didn't pay the cash yet. The cash is due from my customers later. So I am going to put my $150,000 into my T account under the increases section, which is right here. Okay, $150,000. I'm going to put that in right there. Now, let's quickly go over our T account must-knows, okay? Number one, you have to know this, so pay attention. Number one, if the T account is an asset account, which this is, accounts receivable is an asset, its beginning and ending balances will be debits, all right? The normal balance of any asset account is a debit balance, okay? So we're going to have a beginning balance on the debit side, debits on this side, credits on this side, okay? Debits on the left, credits on the right. My beginning balance should be a debit. All right, my increases will be debits when we're talking about assets. Let's go down here. Number two, if the T account is an asset, which this is, increases to the account will be debits. All right, if the T account, number three, if the T account is an asset, decreases to the account will be credits. Okay, and of course, we need to know our T account formula, which is beginning balance plus increases minus decreases equals ending balance. We're going to use this formula coming up in just a moment. For now, we still need to get organized. Okay, we've only started to get organized by putting our increase in the accounts receivable account. Okay, because again, our accounts receivable went up when we sold $150,000 of product on credit instead of getting cash. All right, now, they collected $83,000 of accounts previously outstanding. Let's just stick with that. What happens when you collect an account that was previously a receivable? Well, receivable goes down, right? You collected it. It's no longer a receivable if you collect it in cash. So how do I decrease my accounts receivable? Well, if accounts receivable, which is an asset, increases with a debit, then how does it decrease? Decreases with a credit. So I'm going to expect my decreases to be over here on the credit side, and I'm going to put $83,000 in right there. Okay, what else did it say? They calculated an allowance for doubtful accounts of $3,500. All right, let's come back to that one in a minute. Let's continue with what we have. The ending balance in the receivable account is $121,000. All right, so I know that this is an asset. I'm expecting my ending balance to be a debit because that's the normal balance for any asset. So I'm going to put $121,000 in right here. And it says, what's Maxwell's opening balance in the receivable on January the 1st, 2022? So they're asking for this number right here. This is what the problem is asking for. What's this number? how do I determine what this number is based on increases of 150, decreases of 83, and an ending balance of 121? Well, let's go back and take a quick look at that formula. T-account formula is the beginning balance plus the increases minus the decreases equals the ending balance. So there's 4 components here. 1, 2, 3, 4. And I have 3 of them. I have the ending balance. That's 121 right there. I have the decreases. That was given to me as 83 right there. I have the increases. That was given to me as 150 right there. So the only thing missing is the beginning balance. I have 3 of the 4 components. All right, so then all you have to do is just set up your equation using the numbers. So let's see what we got. We got beginning balance plus increases, which is 150, minus decreases, which is 83,000, equals 121,000 as the ending balance. And then all you have to do is solve for beginning balance, and you will discover that the answer is 54,000, right? This is your unknown. This is your unknown variable. This is a basic algebraic equation. In any accounting class, you will be expected to know how to do basic algebra. So if you solve for this one variable that is unknown, you will get an answer of 54,000. Now, it is always good to check your work, okay? And the way you can check your work is just to run through the T-account formula again using your answer. And I have that right over here under check my work. Here we go. We're going to take beginning balance. That's what I just calculated right here. This is what I believe the beginning balance should be. Plus my increases, minus my decreases. When I go ahead and sum those numbers up, I should get 121, which is what the answer is right here. So it looks like we did the math correctly. Okay? So that is how you organize your information and then use that information in the T-account formula to calculate any one of the balances that is missing. Okay, now that's the answer. That's what we're looking for. That was what it asked for. What's the beginning balance? 54,000. There's your answer right there. Okay, so we're done with the question. However, there's one more thing we want to talk about because we kind of glossed over this point. It says they calculated an allowance for doubtful accounts, 3,500. What does that mean? What are we going to do about that, okay? You know what this is right here? This is what I'm going to call, for a question like this, I'm going to call this a classic professor trick, okay? Professor's going to try to trick you and try to make you think that this 3,500 has some relevance to the calculation here, okay? Under U.S. GAAP accounting, under accrual accounting, which is what we're learning, okay? When you determine an allowance for doubtful accounts, meaning, what is an allowance for doubtful accounts? It means you're not sure you're going to be able to collect all this, okay? Like these customers owe you money. These customers owe you at the end of the year $121,000. But you know what? Chances are there's some of them out there, they're just not going to pay. And so we will be required in future lessons to record an allowance for doubtful accounts. But here's the trick, okay? Here's the one takeaway you need to get from this video on this particular issue. The allowance for doubtful accounts is not, I repeat, is not recorded in this account. It's recorded in its own account, which happens to be called the allowance for doubtful accounts. So in this particular problem, this is kind of like a piece of extra information that you don't actually need to solve this problem. All right, so let's just make sure we summarize that. This is one of those classic professor tricks, okay? When you calculate an amount for an allowance for doubtful accounts, it goes into a separate account, which happens to be called allowance for doubtful accounts. It does not go into account receivable. Let's just look at what the entry would be for that. It's a debit to bad debt expense and a credit to the allowance for doubtful accounts. For, in this case, the amount was $3,500. Okay? Do you see the account called accounts receivable listed anywhere here in this journal entry? No, you do not. Why? Because the allowance for doubtful accounts does not get recorded to the accounts receivable. So you do not need that information in order to calculate this. What you do need to calculate it is you need to get organized using a T account and putting the information you're given in the right place, and then using the T account formula to solve for the beginning balance.